What if I told you that every single month there is a market structure that plays out nearly the exact same, almost without fail? And this structure I've used over the years to not only know when the markets are going to move, but also to profit from consistently. And no, this is not some gimmicky strategy that doesn't have extensive backtesting and data behind it. This is a concept that relies on the mechanics of the market, or how they actually work. Today, ladies and gentlemen, we're going to be talking about OPEX cycles. What are they? Why are they important? How you can utilize them within your own system. So with that, I ask just simply of your attention, and let's get started. So what is an OPEX cycle? Well, an OPEX cycle, or options expiration cycle, simply refers to that leading up into an options expiration date, there are very predictable structures that form into it. And not only are the structures themselves extremely similar every time, but also the timeline in which they form. There's almost exact dates they form ahead of this options expiration. And this is extremely powerful because not only can we get a good idea of what's going to happen, but also when it's going to happen. There are two main phases to an options expiration cycle, that being the shakeout phase and the max pain phase. Each have their own characteristics. Now, this is where we're going to have to pause and back up. I will come back to how to trade these phases individually, but first I have to explain why are we even talking about options expiration dates. Whenever you trade stocks or futures, you need to know this because the options actually move the stock market. And the way I'm about to explain this is going to be your core foundation to understanding why these cycles are effective to begin with. In today's world, retail traders have completely forgotten the importance of options and how they actually move the stock market. Over the last 20 years, there's been a huge rush into US equities. Trillions of dollars has been pouring into the US stock market. And with this huge gold rush into US equities, you've actually had a huge surge in demand for hedges because these big money funds have to hedge their risk. So these big funds go out and they buy billions and trillions of dollars worth of options. And that's really where retail's understanding kind of hits the rock bottom. But they don't realize there's another layer, that there's two sides to a trade. While a big fund is going to buy something like a put to hedge his risk to the downside, the people selling them those amount of puts are known as market makers, and their job is to provide liquidity to the public. Now, their job is super special because by selling an option to the public, they theoretically can take an infinite loss because the put buyer or the public buying those options can take an infinite gain, whether it's a call or a put. And so because this market maker who's tasked with selling all of these options can take infinite losses on this, he needs to balance his own book so that he doesn't blow up for trying to do his job, which again is just to provide some liquidity and skim some profit off the top. So what does the market maker go and do? Well, he's going to go buy and sell shares according to which option he's selling. If someone buys a put from him, he's going to go and short shares. If someone comes and buys a call from him, he's going to buy shares. Again, this is to hedge and keep his own balance. Okay, so what does this really have to do with anything? I mean, the market maker goes and when he's selling these options, he buys or sells shares according to that option. Well, it's because of that side of the trade that you can actually see manipulation in the stock price based off the options activity. The more people buying puts, the more shares a market maker is going to short. So theoretically, if they have all these shares that are short, then eventually they're probably going to have to buy them back because they don't need these hedges forever, which in turn would create buying pressure sometime in the future, right? Because the only way to exit a short position is buy back. Exactly. And what might make options lose value and in turn make market makers need less hedges? Well, the passage of time, of course. Options don't keep their value forever. There's expiration dates. Options will always expire, and as they get closer to expiration, they're naturally losing more value. Why is that? Well, because when someone goes out and buys an option, they're paying a premium. And that premium has time value. How far out are you buying this option? Because that's going to charge you more. But it also has an implied volatility premium for how much of a move is this stock expected to have for that period of time. As you near expiration, the odds of getting those bigger moves decreases and the time value decreases, which in turn sucks the premium out of the contracts closer to expiration. Which means the market maker who was hedging by buying or selling equity is going to have to get rid of his hedges because he was hedging based off the value of these puts. So with the passage of time, options naturally lose value, which in turn means market makers need less hedges. And that means they're going to get rid of those hedges ahead of expiration. So how this pivots into OPEX cycles is through my research. I found that with the passage of time from expiration to expiration, there are key dates that we can actually expect certain movements to happen based around this principle, that market makers are likely going to stop offloading hedges or buying more hedges. And the reason that the market makers are offloading their hedges or buying more hedges ahead of expiration is because these expirations carry a tremendous amount of value on them, and they can't just wait till last minute all the time. They're very smart entities, and they need to balance things ahead of time so that they're properly positioned. And that's exactly what the shakeout and max pain phase are. And the reason this is a cycle is because options will always expire. And that means it happens every expiration. However, there are really only certain expirations that we look at to validate these OPEX cycles that really give us the most edge. And those are monthly expiration dates. The monthly expiration is the third Friday of every single month. And this is going to be the anchor for you drawing your OPEX cycles. There is a special rule we'll talk about because there is certain types of monthly expirations that happen 4 times a year, known as quad witching, that just slightly affect the rules. But for regular monthly expirations, you can expect the shakeout phase and max pain phase to happen 7 to 9 days before expiration for the shakeout phase, and the max pain phase to start 1 to 3 days before expiration. The differences in characteristics between these two phases is quite simple. The shakeout phase can also be called the fakeout phase. It carries a fakeout, like the name suggests, and what you can expect is some sort of fakeout in one direction or the other. So if around this time you see some sort of move down, then you can expect that eventually that will likely actually be reversed higher throughout that time leading up to the max pain phase. The shakeout phase almost always brings a pivot, no matter what. Even if it doesn't bring a fakeout, it will almost always be a pivot level, but majority of the times it will carry some sort of fake out in one direction or the other. Now, the max pain phase, it happens 1 to 3 days before expiration, is typically a pin move. And what I mean by that is it causes a pain for both sides of the market. Say we have a market steaming up towards max pain, you can expect a kind of trapping or sell off into that expiration, because what happens is when you get closer to an expiration, the effects of the Greeks become so great on options that it becomes very sensitive. And so every drop, the market makers having to buy up stock, and every pump, the markets are going to have to start selling off stock. Again, to remain balanced, although that's for another video. So what you actually expect is some sort of sell-off or some sort of pin move that traps both sides of the market and creates a balanced close to the expiration. That's why it's called max pain. It's pain for everyone, bulls and bears. Now, the timing for the quad witching months are slightly different. While the shakeout phase and max pain phase remain the same in their characteristics and what we expect of them, the timing of them are different. For quad witching months, which happen March, June, September, and December only, again, the third Friday of those months as well, they're called quad witching. They're much more important because there's a lot more money expiring on the same day, because that's when futures also expire on the same day together. And so with so much money expiring on that same day, the market makers are actually preparing way beforehand, much more. And so what you can actually expect is that the shakeout phase happens 30 days before that quad witching date, which again is the third Friday of March, June, September, and December. And then the max pain phase happens around 14 days before. So let's see this principle in action, and we can do so by going back in any year in history and applying these principles. So first of all, what I've done for the year of 2021 is I've outlined each monthly expiration, the third Friday of every single month. In purple, I have outlined the quad witching months. Remember that the only difference between how we treat regular monthly expirations versus the quad witching months is simply the time of which phase we expect when it occurs. And so the first kind of month we can look at is January. And what we'll do for this experiment is just do 10 days before for the shakeout phase and 3 days before for the max pain move. And for the quad witching, we do 30 calendar days, not 30 trading days, but 30 calendar days. And then we'll do 14 calendar days before. So we'll go month by month quickly here. And you can see, so for the first month of January, around the shakeout phase, what did we see? Well, we did see, not exactly to that date, but you can see plus or minus 1 or 2 days, we had this massive push down around this area and then a big buy up here. This is the shakeout phase. This is where we see typically a fake out in one direction or the other. And in this case, we saw a massive candle down, and then you saw that green higher. That was likely to be where the reversal was. Into max pain, you can see that we did have kind of a pin. We had a kind of chop and then a slight sell-off into the expiration date. This is very consistent with, of course, the idea that max pain for both sides is trapping both sides and eventually likely selling off into it. Now, the next month right here, you can see 10 days before, 11 days before, what did we have? Well, we really did not have a fake out, but we kind of did. We had a change, and I mentioned earlier that it's not always going to be a fake out when you get to the shakeout phase, but it's going to be a pivot, an area where the market dynamics change. And so right here, you can see as soon as we hit this date, we started to really chop. This is where the market dynamics significantly changed. And you could see that we did have a sell-off. So you could say, well, wait a second, this is the fake out. But in turn, it was really just a change in market dynamic. It was not so much a up and down. And you're not always going to get that. But what we can always count on is that these dates are pivots where you can expect the market behavior to change. And you can see 3 days before we started to sell off, but really, again, trapped it into a range. That's why we call it the pin move. Now for quad witching, you'll notice this right here, that this is 30 days before and 14 days before. And so what you'll notice here is 30 days before the quad witching. I would have already been going off of this one more so of this one for this month. But this one right here, 30 days before, again, because so much money expires on it, this is the bigger objective for the market makers. And so 30 days before, we had the start of the shakeout phase. And you can see right here, instantly, boom, we started to have a directional pivot. Again, this is where you expect the dynamics of the market to change. Now, through this shakeout phase, what you'll notice is, as we came down into this, you really did have that kind of fake out in one direction. And that this bigger move was kind of the fake out. It was the fake out in one direction higher, and then all of a sudden, boom, lower. And then you get, again, that reversal into that higher area. Max pain starts around here. This is where you expect another pivot, and we did get that. You can see right here, max pain corrects that imbalance, and then eventually you get that slight pin move 2 to 3 days before. But again, all we care about is the 14 days and the 30 days before. Okay, moving on to the next month. So again, we can just do 10 days since it is a regular monthly expiration. And you can see 10 days before, you really had, again, not necessarily a fake out, but you did have a major pivot in the market. You're not always going to get a fake out, but what we can count on is a fake out, but ultimately just a pivot in the market. And then 3 days before, you also had a change in market dynamics where it started to chop and then just had a slight pop into it. Now you can see again, the next month here, we had being 10 days, and then we'll just do the 3 days again, 2 to 3 days before. And you can see right here, 10 days before right here, boom, this was kind of where we saw a massive move higher and then a sell-off. And so we expect, okay, well, wait a second. We saw a move higher and we're starting to sell off. That's likely going to be the start of the fake out higher, and then we're just going to have some more selling pressure. So this is where you can expect more selling pressure. This was the fake out. And then 10 days before, really, you had this selling pressure, boom, you start to reverse into max pain. Max pain kind of traps it like that. So that's how you want to anticipate it. Again, around these specific dates, they're not always going to be exact, but you can expect some sort of pivot, some sort of max pain where it chops around this date or into this date, something like that. Now, we could go on, and I could show you every single year in the past, but that wouldn't be very efficient. And also, looking at hindsight can kind of be deceiving because how do we make these decisions in real time? The best way I can first show you is a live example of me implementing this into my trade plan through a previous YouTube video I posted. Here was my game plan. The markets right now, to most people, are making 0 cents. I mean, you got Apple up, you got the VIX up, the dollar down. What is going on? Well, my name is Raider, and I believe the next trade in the markets is going to be to the upside. Now, the first step to understanding why I think the markets are going up is starting with the SPY chart here. Just a few weeks ago, we started to slow down in the markets towards this all-time highs. And as we got to around May 22nd, we were in a happy, nice little parallel channel. And that was chopping upwards. All of a sudden, Thursday, which was May 23rd, comes around, and we take out both sides of the channel. This is extremely significant. Let me explain why. Whenever a market forms the liquidity structure, like a parallel channel, and you take out both sides, what are you doing? Well, you're taking out all the sellers and you're taking out all the buyers. So what's left? Nothing. So there's actually a liquidity void back into that range. And as price came back into it, SPY did around that 528, 529, markets just expanded. We knew this expansion was coming. I talked about it on the RADER report, and in this case, it was down. So we've expanded. Everything went according to plan, but what is next? Well, with this big response off this 521.50 to close out the day, I actually believe the next best trade is going to be the long trade, but not where most people are looking. And this isn't just my opinion. There are some significant data points to support this. First of all, seasonals. When we look at seasonals, the beginning of June is often bullish. You can see by this chart, right around around the June 6th to June 7th time is when we see a fake out or reversal in the markets. But until then, we can expect strength. Now, seasonals are an excellent guide to knowing the price tendencies of the market, even so more than direction, right? Is it going to be choppy during this period, or can we expect some sort of expansion? June in general, unlike April and May, tends to actually expand. So we're not going to get the boring summer chop that April and May brings. And on top of that, June houses the June 21st expiration. Now, many of you might not know what this is, but this is the quad witching date. This is when hundreds of billions in derivatives or options expire. You have futures, options, all of that stuff expires on June 21st. Market makers are going to be sweating. They need to move the markets. And there's a nice little trick that I have to kind of predicting when markets will move. Around 30 days or so before a quad witching or June 21st, you get a shakeout phase to start. And that's almost to the day what Thursday has done. So what is this shakeout phase? What does it characterize as? Well, it characterizes a shakeout, a fake out to one direction or the other, and it gets as many people out of the market as possible. So is this move down that? I believe so. When can we expect another move? Well, right here on this chart, you'll see this horizontal blue line. This is around 14 days before, and this starts the max pain phase. This is where you can expect another pivot in the market. So this week, we should get a better sign as to the real direction of the markets here. What else is supporting this bullish thesis? Well, first of all, the NAIM number. This shows the firm's leverage in the market. They are still very willing to buy the dips and increase their leverage in the market. And with that huge uptick a few weeks ago, that has not sunk yet. And if we look at other things that kind of indicate the health of the market, we can look at banks. Banks did not make a new low today despite the markets making a new low. Banks not making a new low while technology is like the most classic sign of a market bottom. If you guys remember back in April, this is one big factor that led me to believe that the April bottom was on April 19th. I'll kind of put that up on screen here. You can pause it and read it if you want. From that clip that I just showed you, hopefully you can see how effective OPEX cycles are. Not by themselves, but given the market context, not only do we get a hint at the direction, but also more importantly, the timing of the markets. By knowing when market makers are likely to start rebalancing and repositioning their hedges ahead of that options expiration, we can really pinpoint when a move would happen. In the clip that I showed you, we had kind of this stage set for a market bottom. We had banks failing to make a new low, which is extremely bullish. We had different components leading into that thesis as well. And that OPEX cycle gave us a now. It was the time to bottom. We knew the direction, but the timing is always the hardest part. And on screen now, you'll see the post effect of this video. You can see right here, exactly after that point, we actually saw the market rally a significant amount. And to give you further repetition on this subject, we can actually look at the current price action as of February 13th to see what kind of idea we're getting from these OPEX cycles. So right here, we have our OPEX drawn on my chart. I always do this. And you might wonder as well, Raider, what do you chart? I only chart SPY. This only works for charting the SPY. Now, you can use it to time trades on individual stocks, but from a cycle perspective, the number one assets in the world that are rebalanced by market makers are going to be indices. So stick to SPY, stick to QQQ, the Dow Jones, or IWM. I only do it on SPY, but you can certainly match the same timing of SPY with other stocks in your entries. So right here, we have the OPEX, then I do 14 days before, and then 3 days before around here is going to be your max pain. Your shakeout phase, remember that this is not a quad witching month, so the effects of the shakeout phase are going to be much smaller than, say, a quad witching cycle would be. So right here, you can see on that day, almost specifically, you had kind of this drop down, and then you had this kind of move down, but eventually it got bought up, right? This was kind of the fake out. That right here, you had this kind of drop down into this, and now you're coming back up through it. Again, it's not perfect to the exact day. At the start of the week, what I put in the RADER report after I discussed this topic, there's two scenarios that you actually want to see play out. Number one, you could see a fake out to the downside. And in that case, if we drop this week, it's likely we rally up into this week. And again, that's based around that shakeout phase principle. The other scenario is that really you could see some sort of pop this week and then some sort of drop earlier out in this kind of longer dated into this. So you can see that the number one, the more dominant thesis that we actually took was this right here. We saw some sort of drop and then we saw ultimately that pump. While it didn't play out exactly, you can see the lines, of course, are a rough estimate. You can see that we really did kind of have that little small pop, but ultimately that drop and then the pump. That was the more likely scenario to happen given the context of the market. And so what that means is as we near OPEX, we have to understand that the weaker seasonals are after February 21st and into that. So the next place you would be willing to take shorts on is actually around Tuesday of next week, February 18th. So if you're watching this in hindsight past February 18th, tell me how I did, how this plays out. But what I will tell you is, of course, that around this area, I'm going to be trimming my long positions, getting out of Tesla, getting out of QUBT, other trades that I've outlined on the report, even such as Target, these names like this, of course, that we've outlined for a bounce. This is a time to start getting out of those names. And that's going to be when you want to reposition more into short trades and start considering that idea into the OPEX. So we'll be watching into next week. We expect some sort of pivot, some sort of change in market dynamics ahead of options expiration. And it's likely, given the seasonals, given the weakness in the overall market, to be to the downside. But for now, we have to respect the momentum as the shakeout phase is still underway, and that as we near that kind of fake out, we've already had that shakeout. We're coming up into the max pain. That's where you expect another pivot, and that's where we can make more decisions and alter our game plan. So throughout this video, you learned that market makers will actually move the stock market based off the options market activity. And into these big options expiration dates, we can expect very predictable actions coming into those dates as they're forced to rebalance, with options losing value through the passage of time. You also learned the two different phases of the OPEX cycles, the shakeout phase and the max pain phase, both occurring at different times depending on whether it's a quad witching month or a regular month. This principle I showed you today is based off the mechanics of the market, or how they actually work, which is what my mentors have passed down onto me and how they influence my trading style. All the concepts that I trade off are based off of how the market actually works. And that's different from something like a pattern where I just point and say, that looks like that, so it must be that way. But there's no underlying reason in the markets to say why a crab harmonic pattern works out. It's just a simple observation, and the analogy I always use is the ice cream to crime rate. Ice cream and crime are not directly correlated, even if the statistics move together. One or the other is not a cause of each other. But the way that I trade and the way that I'm showing you is a direct cause, making it much more probable that you're actually on the right side of the odds in a profitable trade. So my call to action to you is go map out the last 10 years of price action data. You can look up simple option expiration calendars online. Just type in options expiration calendar 2019, 2018, 2017. Go back through and map out each year. Take note, map out the different days, what the shakeout phase typically did, and find common occurrences that you see. Is it happening a day before? Is it happening 11 days before in your opinion? 7 days before? What is the typical sweet spot that you find yourself looking at? And you can always feel free to message and reach out on social media, or comment down below your username on Instagram, which you message me through, and I will take a look at your work. Now, if you simply just don't have time for all that, you can always sign up for the RADER Report, which is where I talk about everything important related to these concepts through a professional research report that I release every single week before the week starts. So not only will you always be kept up to date with my opinions and my professional research and data backing my decision making on concepts such as the OPEX cycle and how we're positioning into this week, but also you'll be exposed to directly why these concepts are important. You can get access to hand-built live data tools that I've built for myself that are useful to me, that I use every single day, as well as private lessons and more. I promise these reports are like nothing you've ever seen. I mean, even just this week, we talked about the Tesla bounce that we would likely see, and we got exactly that. It was based off of a hedge order and really just a big technical level that hedge order was going to likely cause a reaction off of. And one of the bigger percent returns this week was MS. This was around a 200% put trade that was basically betting on banks selling off first before the broad market did ahead of this shakeout phase, which, surprise, surprise, it absolutely dumped. But if not, we always have free Tuesday lessons through the RADER Report every Tuesday at 7 p.m. EST that you can always join and learn from. All you have to do is sign up. All you have to do is sign up with a free account. You can literally just click the Zoom tab and join every Tuesday at 7 p.m. EST. Other than that, guys, have a great rest of your day. Bye-bye.